Greetings from Kotak Mutual Fund. The election outcome has come against the market and exit polls estimate. The focus will be now on government formation by NDA, analysis of the election verdict by NDA, and recalibration of policies. It is likely that support for consumption at the bottom of the pyramid will be considered to create inclusive growth. The markets will take its time to analyze these developments. The global backdrop is also changing rapidly. The world is moving from globalization to protectionism. Interest rates are likely to remain elevated. Fiscal stimulation will recede. Environmental consideration, along with technology disruption, will adversely impact many businesses. The market, against that evolving global backdrop, will also look at some of the positives. One, we are the fastest growing major economy, and our faster GDP growth is translating into earnings growth. For FY24 Nifty 50 earnings, it came 3% higher than what was anticipated at the beginning of the year. FY25 and 26 Nifty 50 earnings is likely to witness double-digit growth. The earnings are also fairly broad-based. Financial services is contributing disproportionately to incremental growth, while IT and chemical are subdued. While geopolitical risks exist in the Middle East, Eastern Europe, and South China Sea, there is no adverse impact on the supply or price of the oil. Announcement by OPEC and Russia to restore partial production cut will keep oil prices under check. The Fed rate cut has been deferred from mid-calendar year 23 to probably end calendar year 24. But the market continues to believe that Fed rate cut is a question of when and not if. With fundamentals in place, and if domestic flows remain strong, then market can look to bottom out once there is clarity on government policies. Foreign investors have booked profit in this financial year, but my feeling is that they will look to buy at lower levels as their position on India is somewhere around neutral. Our market cap to GDP ratio is well above historical average at more than 130%. However, corporate profit to GDP ratio is also above average at about 5%. The listed company's leverage ratio is also well below averages. This has kept valuations from becoming expensive. Corrections are setting in that part of the market where floating stock was limited, holding was concentrated, and valuations were high. We were cautioning about it for last 6 months, and we were wrong for 5 months and 29 days. But such is the irony. Post-COVID bottom market has delivered returns which is well above the trend line, driven mainly from small and mid-caps performance. We expect returns to moderate as valuations weigh in, especially in the bottom half of the market cap. Quality stocks will outperform momentum stocks. Low floating stock counters will correct further if there is more supply. The derating cycle of FMCG and private bank seems to have bottomed out. Election spending and good monsoon can support consumption. Valuation in IT and chemicals are factoring in current challenges. The market will watch for June quarter commentary on order flow in IT sector and Chinese competition in the chemical sector. Election-related volatility will eventually settle down, but outcome not turning out as per the market's expectation will reset the base. While traders will have their opportunities, we expect investors to make more money. Our economy and corporate profits will expand multiple times over the next decades. Stocks, being slave of earnings, will move in the same direction. Truly, this is the beginning of Amrit Kal for India, and it will make sense for investors to participate in this journey of becoming Viksit Bharat. Undoubtedly, there will be ups and downs, but fundamentals are in place for Indian economy. Domestic flows should remain strong, and at correction, global capital also will find its way to India. Our governance standards are superior to our peer group. This combination of 3G of growth, governance, and valuation will come into play. Stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.